Great, I make that 9:30 by my count, so we'll get going. Welcome everyone to our crypto taxation webinar this morning. Thank you all for joining us at 9:30 on a Thursday morning. We do have a fair amount of ground to cover with you today. Just as a reminder, this will be recorded and available to view in due course. So we're going to whiz through today a reminder on taxable transactions when it comes to crypto, how to go about disclosing any tax liabilities that arise from those crypto transactions. And then Sean will be delving into record keeping and best practice on that, which of course is necessary to help us make those disclosures when it comes to crypto. We will end with a Q&A, so you should have a chat box or a question box. Feel free to post them throughout, and Sean and I will get through as many as possible at the end of the session. So to kick us off, we do have a quick poll, and we'd be grateful if you could fill this out. It is anonymous. It's how confident are you with crypto taxation? So how confident do you feel with knowing what's taxable and what to do about those taxable transactions? So the answers are extremely confident, fairly confident, or not confident at all. And of course, there's no shame in what you answer. We'd be grateful if you could fill that out over the next minute or so. In the meantime, it's worth just introducing ourselves briefly. So I'm Georgia in the Menzies Tax Disputes and Disclosures team. So I specialise in disclosing historic tax liabilities, settling tax schemes, dealing with complicated inquiries, that kind of thing, all things HMRC related. And that covers voluntary disclosures, which incorporates crypto disclosures. And we're both members of the Menzies Technology Sector team. And Sean?
Hi everyone. Yeah, I am a senior manager in our private client team here at Heathrow, in the Heathrow office, ranging the things from tax returns to assisting with disclosures, but specialising in the taxation of crypto. So hopefully you'll be able to provide some information during this webinar to for those who are not confident at all to move themselves up to at least fairly confident, if not extremely confident. So I think the votes are coming in now. So
Yes. Yeah, thank you for filling that out. Interestingly, no one says extremely confident. Well, that's very honest of you. For those who are not confident at all or fairly confident, hopefully the next 30, 40 minutes will give you some insights. Obviously, this is quite a complex area, lots of things in tax. So if you do have specific circumstances, niche circumstances, always worth asking questions, seeking professional advice where needed. But thank you for filling that out. Great. So touching on taxable transactions, as a reminder, without going into too much detail here, as we could very well be here all day, it's a reminder of what is and potentially isn't taxable. So when we're looking at crypto activity, probably the most common type of taxable transaction you'll come across is a capital disposal. And that happens when you sell a crypto asset, but it also happens when you swap one for another kind of crypto asset. You're disposing that first one, and also you're disposing of a crypto asset if you're using, for example, a token to pay for goods and services. Do note, though, a simple transfer of the same type of crypto asset from one wallet to another wallet, when those wallets are owned by the same person or entity, that does not give rise to a taxable transaction if it's just a simple transfer under the same ownership. If you do have a capital disposal, then you can make use of your annual exempt amount for capital gains tax. You may know that this has fallen in recent years and is currently £3,000 in the current tax year, which means briefly that you only need to make more than 3K in profits on any capital disposals. So that includes crypto and other assets before you end up with a capital gains tax liability. Income tax generally is charged on trading income. As per the quote from the HMRC manuals here, it is very unlikely that someone's crypto activity is going to amount to a trade. If you are concerned about this, each case does need to be determined by its own merits against the badges of trade. But generally, as you can see by the quote here, you probably won't be spending the time and the level of organization, and if it's not your full-time job, then I wouldn't worry too much about that. Otherwise, income tax can be charged, for example, if you happen to be paid any employment wages in a crypto asset. That is because obviously employment income would be chargeable to income tax to begin with, and NICs. And then mining and staking activities, unless the activities amount to a trade, they'll generally be charged to income tax, but as miscellaneous income. So the key difference there is you'll still be charged income tax, but miscellaneous income isn't chargeable to national insurance contributions. Specifically on airdrops, the guidance from HMRC still remains that where nothing was done to earn those airdrops, then there's no tax chargeable. Only earned income is chargeable to income tax. Something that came up in some of the advanced questions that were submitted to us is are unrealized gains taxable? So to be clear on this, where you own one type of asset, let's say one token, and that the value of that fluctuates up and down, any increase in the value of that token is not taxable, just as any decrease in the value isn't, you can't use it as a loss. But if you, it's worth us emphasizing this quite strongly, if you swap that token for another token, then you have made a disposal. So let's say you might end up in a circumstance where you dispose of the first token for another type of token and you've made a significant profit. You'll eventually owe capital gains tax, most likely on that profit, and you'll have to pay that to HMRC in pounds sterling. If you hold on to that second token then, and the value of that token happens to decrease, such that you don't end up with much in fiat currency at the end of the day, that doesn't impact the fact that you made a disposal of that first token. So it's really important that you keep track of these taxable transactions on an ongoing basis throughout the tax year, just in case you're realizing these big profits, but not actually taking it out in cash, in pound sterling or another fiat currency, just so that you have enough to pay the tax bill when it comes to the end of the tax year. So this, again, is another quote from the HMRC crypto manuals. Essentially, the message here is that the guidance remains the same, but it could change at any time. There are no specific crypto tax laws. We use the general principles of existing tax legislation to determine any tax liabilities on these crypto-related transactions. But that's not to say that won't change in future. Obviously, big news with the election coming up. We don't know what's going to happen. We can't predict that. And there's nothing at the moment to say what could happen with a future government. So really, this is just to say it's important to keep an eye on these things. If at any point you're unsure, seek advice. But we do rely on existing tax legislation. Again, someone asked in the advanced questions if there's any crypto case law. There is plenty when it comes to crypto scams and things like that. But when it comes to specifically tax and crypto, this is still relatively speaking new. So we don't have any tax related cases with crypto that have made it to tribunal as yet. Of course, as and when that happens in future, that will be very interesting to us. And that could help shape any future specific crypto tax law should that ever come into fruition. But for now, we are very much in the hands of existing case law. So for example, just going back to whether activities amount to a trade, we do have some case law in that area when it comes to trading in stocks and shares. So essentially the guidance from HMRC is we use equivalent case law. Great. So once we have ascertained what kinds of taxable transactions we have, we need to make sure that we are compliant on an ongoing and future basis. Excuse me. So this means filing self-assessment returns as an individual, or if you're investing crypto through a company, then obviously you might need to include that in a corporate tax return and your company accounts instead. As a reminder, if you're new to self-assessment, you would need to register for self-assessment by 5th of October following the end of the tax year. And then those familiar with self-assessment will know that we file those tax returns by 31st of January each year. So for 23-24, you've got until 31st of Jan 25. So there's plenty of time to work out your tax return for the past tax year if you're worried about crypto activity. From the next tax year onwards, you'll hopefully notice on those tax returns that there are the self-assessment tax returns, that there are crypto-specific boxes on those returns for crypto income and gains. And this is all part of HMRC's efforts to raise awareness that there are tax obligations of crypto asset activity. If you have been doing this for a little while, but for whatever reason, you haven't put anything on a tax return, then the two important things are firstly not to worry, but secondly to act sooner rather than later to rectify the past. So in November 23, HMRC opened a specific crypto asset disclosure facility. Again, this was all part of their sort of strategy to raise awareness about crypto activity and tax obligations on that, and to encourage taxpayers to come forward voluntarily to disclose any historic tax issues. This facility is one of several that HMRC offers, and it enables a taxpayer to bring their affairs up to date where they have made an error or they've omitted income or gains from past tax returns. So briefly, the process is we make an initial notification to HMRC. After that notification where we're registering for that disclosure facility, we then have 90 days to prepare the full disclosure. So you'll need to prepare full computations, and that should cover the tax, but it should also cover late payment interest calculations and a self-assessment of any penalties that are due. Our approach here at Menzies in the disclosures team is to also prepare an accompanying disclosure letter or report, and we submit that alongside the numbers. And this helps us to explain the basis of our calculations and any assumptions or estimates that we've made. And we find that this can bring the disclosure process to an end much more quickly and efficiently. I would say it is important to engage with a specialist disclosures advisor. Not only will you want reassurance that you're not declaring more years than you have to or paying higher penalties that you need to, but as I say, it can make the disclosure process more efficient. And especially in something like crypto, it can get really complicated, particularly if you have, for example, a high volume of transactions and you need to worry about things like share pooling, or if you have more nuanced transactions such as lost tokens or forks, or if you're wanting to claim any kind of historic loss relief, it can get really complicated. So I would recommend seeking some advice. Interestingly, as of about a month or two ago, HMRC confirmed they'd had just 38 disclosures under this new crypto asset disclosure facility. That's not to say that there weren't more prior to that under the existing disclosure facilities, but we do envisage that that number will increase, hopefully fairly significantly over time. I should point out at this point that if ever there are concerns, the behavior behind omitting those crypto transactions from tax returns is deliberate, then a voluntary disclosure facility under this new crypto disclosure facility wouldn't necessarily be the best mechanism to report those tax obligations. Something called COP9 or the contractual disclosure facility might be more appropriate. But if ever you're concerned about that, again, that is definitely something worth seeking advice about. You might think, why should I make a disclosure on my crypto activities? Maybe you don't have that much, you're not investing that much, there aren't that many transactions, or you wouldn't otherwise need to fill out a tax return, or you've been doing it for several years and you feel like you've never needed to until now. Well, as I have mentioned, this is an area of HMRC interest. Combined with the new facility and those boxes on the self-assessment tax returns, it does highlight that they are looking into this, and that's not going to go away soon. With that in mind, HMRC do issue what they call one-to-many letters, what we might call a nudge letter. If you receive one of these, then it's safe to say you are very much on HMRC's radar, and you do need to reply to those letters. We would recommend that even if there is no tax obligation. If you don't disclose and HMRC come back to you later, that might give rise to further scrutiny in your wider tax affairs, which you might not want. And if they have to prompt you, then that will incur higher financial penalties for you. So making an unprompted voluntary disclosure is always the best thing to do. We also have a system in the UK whereby we share information with offshore jurisdictions under the Common Reporting Standard, or CRS. And this is expanding to crypto activity, specifically under what will be called the Crypto Asset Reporting Framework, or CARF. This means that you might not be on HMRC's radar now, but their information gathering powers are growing, and you may well be found somewhere along the line in future. And of course, coming forwards to make a disclosure first means you retain control of that process. It can be much more efficient to come forwards first. And getting that closure notice at the end of the disclosure process will give you peace of mind. Similarly, another reason you might want to make a disclosure is if you've made capital losses, for example, you might be able to utilize those against other capital disposals, whether that's crypto or other capital disposals elsewhere. So perhaps if you've been investing for a few years, but you think, well, I haven't made any profits, I have no tax to pay, it might be worthwhile making a disclosure anyway, so you can crystallize those losses and use them now or in future. So in order to make a full disclosure, whether that's on a tax return or as part of a historic disclosure under this facility, it is really necessary to ensure that you've kept a good record of your crypto activity. So I'll pass over to Sean to talk about that.
Thank you, Georgia. Yes, the importance of record keeping. A lot of this, if you're already in the tax system, completing tax returns annually, you'll know the importance of record keeping each year just to submit your tax return. So when you're looking at record keeping, for example, just for a tax return, depending what is involved in your tax affairs, there could be various records from different third parties or banks, for example, for obviously bank statements for interest, keeping it simple. And the importance of this is to ensure that what is submitted to HMRC before the deadline is complete and accurate. This will hopefully stop any queries coming back from HMRC, and if we do this in advance, to stop any disclosures having to be sort of submitted further down the line. So this does sort of overlap into sort of the crypto asset sector, which you may be new to, as Georgia mentioned, coming into the system. So there are deadlines to meet in terms of registering for self-assessment to report any crypto activity and transactions. But it comes extremely important with supporting evidence to HMRC if they are to ask any questions through an assessment or an inquiry. So having these records on file, easily accessible, that we can present this to HMRC in a very clear manner, tends to speed up the process, save time and cost in getting this all sorted and letting them leave you alone to get on with your day-to-day job and investing. As per the HMRC manual, which Georgia has touched on, the onus of keeping your records and supporting evidence is on the taxpayer. This is the same with tax returns in general, and also it's relayed into the crypto assets sector. So it does come down to yourself as a taxpayer keeping these records, and this, from a crypto perspective, covers sort of a lot more basis than just the day-to-day sort of tax world that we see. So which lays on to point 4 here, which allows us as advisors to sort of review the documentation, making sure that there's nothing obvious that's sort of missing or that any third party hasn't provided you with, to make sure that what we're reporting to HMRC is accurate. If it is missing, from experience, we should be able to advise where to go to get this information. And all in all, the whole record keeping process is to ensure that there's less communication with HMRC, or just as much as you need to clear any points. So moving on to the next slide, which is more the interaction with the crypto asset exchanges, platforms and protocols. So I've listed just a few here. I could have probably done another, I don't know, 10, 15 slides just listing out the names of crypto exchanges that you may have heard of. If you're new to this, there are some on here that are relatively, I say, new in terms of how many years they've been around. There are some that have been there since the start. So this is where the interaction comes in with record keeping. Is all of these exchanges will have a slightly different format or outset on where your account settings are, where you access information from. Some of these exchanges listed on here are no longer actually in existence, but you may need to contact them to get information required to complete a tax return for the previous year or the current year, if you still have funds, or did have funds on that exchange. But as Georgia mentioned, there could be losses that have been incurred. But in order to use these as part of the reporting process, we would need to gain reasonable supporting evidence that this token or exchange that you held is no longer in existence. Some of these exchanges you may recognize if you're into sports, sort of crypto.com is quite a big one there, and OKX if you're into football, Man City sponsors. So these things are becoming sort of more in the public eye, and more people are becoming aware of or then researching what these exchanges are and what they involve. So each exchange and platform, as I mentioned, will have sort of a different outset or a layout. But the protocols of each one, from my experience, are all closely linked but very different at the same time. So the protocols for each exchange is, in simple terms, sort of the terms and conditions or how they view the legal side of mainly being the beneficial ownership of such tokens you may own. A lot of these will also link to digital wallet addresses that you may own personally. A lot of them you may have to either download one of their digital wallets to be able to transfer funds into and from. Some of them may make you exchange a token into their token of choice to be able to transact on their exchange. And an important point that Georgia made earlier, swapping one token to another is treated as a taxable position or disposal, which could generate a liability that a lot of people may be unaware of or may not have the funds at the end of the tax year to complete this payment. So, yeah, reviewing the exchanges, platforms, and the protocols of each one is very important. So in regards to collating all the information you would need from a record keeping perspective for crypto, this can get quite complex and can take some time. So if you use, let's just say, 4 of these exchanges, you'll need to obtain information from each exchange, and somehow there is various ways of doing this through third-party softwares or through an advisor like ourselves of collating this information into one. Because as Georgia briefly mentioned, share pooling and share matching rules is what is used from a tax perspective to attain what your tax liability position would be. So you'll need the same information from each of these platforms, but they'll all be presented in different ways. And if, for example, one of the exchanges is no longer in existence and we've sort of forgotten about it or think we don't need it, if there was a transaction from one of your digital wallets that went through, for example, crypto.com to move it to FTX and back out to somewhere else, if this one particular exchange has been sort of forgotten about or we've missed it off, when the transactions are calculated, it is likely to treat this as a disposal, and which gives the opportunity of a capital gain generating. Whereas if that wallet address was included and we know where it's moved to, it could potentially be that it didn't need to be within that calculation at all, and it's a non-taxable event. So it's very important that you've got all the information from all these sites. And a few third-party softwares that I can mention that we've used from experience when gathering this information is Coinly and Recap.io. These sort of do the same job that we can here in terms of requesting the wallets and exchanges that you use, putting them into a calculation to generate what they believe your income tax and capital gains tax liability may be for the tax year. I say not a weakness, but obviously an area which these third-party softwares won't be as versed on is the sort of the taxation of all these transactions and all the different types of transactions that can occur. So it may be listed as a disposal, whereas us as advisors would know that it's not a disposal and it needs to be sort of edited or manually looked at to make the adjustment so that your tax position is correct at the end of the year. Because the last thing we want taxpayers doing is paying more tax than they need to and having to go back and correct that, which also can be done. But again, it's another process which we would look to avoid. And the share matching rules, just to go into that a little bit more detail, each crypto asset alone has its own pool. They're not all mixed into the same one, and we have an overall sort of crypto liability. For example, using Bitcoin or Ethereum as ones that you may have heard of will be in their own separate pool. And for each transaction that goes ahead, you'll need to know the date the transaction took place, the number of units that were moved or transferred, the value at the time of the transaction are the key ones. But this information across all the platforms, again, needs to be collated together to get a final position. So I think I can move on to my final slide, which is quite important, the advice and recommendations from our experience of what we've seen from some clients and also personal experience of being involved in this space. A key one for me is researching these platforms and exchanges that you're potentially using for a number of transactions. As I mentioned on the previous slide, there are some that are no longer in existence or have shut down for a number of reasons. there's ones on there that have been around since the start, so they are more sort of up to date and they upgrade as they go to assist you as a taxpayer. So their systems might be a lot more easier to navigate and get the information you need from it. It also might be easier to move funds around on and off the platform, and also request any particular documentation that HMRC may have asked for once we've completed a submission of a tax return. Us as advisors, obviously, we think it's extremely key to speak to us before, even if you breach into crypto assets for the first time, any sort of recommendations we can make in regards to your security of your funds, what documentation you will need, what you need to look out for. Hopefully, we've covered quite a bit so far in this presentation. But we have had obviously a lot of key questions coming in, and as the space evolves and HMRC produce more guidance, hopefully going forwards, depending on, like we say, the government situation, which we'll find out later on this year, if any changes are coming, we should be made aware of those in advance and can advise on any changes that need to be made to how you're reporting currently or how you will need to report going forward. With the new tax returns for the next tax year, hopefully having a separate area for us to actually present this information to HMRC and avoid any confusion. Finances, which is obviously an important area for everyone. What I found from researching a lot of these exchanges, some, as I mentioned, you may have to change certain cryptos into another to be able to use. It may be easy to access and buy sort of different crypto assets from a certain exchange, but it might be extremely difficult to withdraw the funds back to the same bank account. You would have seen in the news, I'm sure there's various different banks that do allow crypto transactions, and there's ones that no longer do to certain exchanges, some for good reason and some for regulation reasons. So that comes into sort of the research box in moving funds to and from one another, whether it's from the exchange to a different wallet or whether it's back to a bank account that you use. It's also important from a tracking perspective with banks and digital wallets. As I mentioned, with the collating all the information, if some movement has gone through a different bank account or a different wallet that you haven't used before, to make sure this is included when you're bringing all your exchanges and all relevant record keeping together to make sure that nothing's missed and we don't have any higher tax implications than we should have. And obviously, the best topic here of tax that we do each day, George has obviously touched on the income tax and capital gains, which are the ones we see most regularly when it comes to crypto assets. However, I thought it was important to note on inheritance tax, although this area is less spoken about for obvious reasons, but with the potential changes coming up with the current or new government in this area, it's important to know that this asset class does contribute to the value of your estate, which could increase the liability. IHT currently at a 40% rate, so there is potential planning and opportunities to discuss here. There's also the implication from, say, your will perspective, making sure that these assets are noted. Having access to these is, as I mentioned, accessibility just to the documentation, but also access to the exchanges or where these funds are held. From an IHT or probate perspective, distribution of funds, it's important that these are able to be accessed and distributed accordingly. If keys are lost or unknown, as was alluded to in the first section, if these can't be accessed, then they're essentially lost, and we have to prove that these can't be accessed and prove what the value was in order to make any claims to use those losses. Value added tax or VAT comes more into play if you are aware of NFTs or non-fungible tokens. If you've been in this space for a while, you may have heard of these. If you're brand new to this, and asked to explain from start to finish how these work. But VAT is an important matter with NFTs if you are trading in these on some of these exchanges that I mentioned. OpenSea is probably the most common one. But it's just something to think about if you are trading in the crypto asset space. Not so much so, but from an NFT perspective, most definitely. And Georgia touched on the corporation tax. Obviously, if you have incorporated into a business and you're operating that way, corporation tax will likely be due and payable. And finally here, just the CITES, which we do get a lot of questions on or queries in terms of when HMRC need to be notified and who is affected by reporting standards in the UK. From a crypto assets perspective, if you are a UK resident, then this asset class will be treated as taxable in the UK and needs to be reported to HMRC through likely a self-assessment tax return. Obviously, there are potential planning points if you are arriving in the UK or leaving the UK. Again, another matter we're happy to touch on and discuss in a future webinar. If there's any questions or sort of queries you want to send us direct, we'd be more than happy to cover that. So hopefully that's given you an insight into sort of the record keeping and the complexities that come with that, and that we need to be sort of organised and in order to make sure we're reporting the correct information to HMRC. And I think we'll move on to some questions that may have came in, but before that, I will just cover, I know Georgia covered a few in hers. There's a few others that did come in which before the webinar, which may have already been covered, but just to sort of touch on those so they're answered for you. Transfers of NFTs and tokens between relatives, is this a taxable transaction? If the transaction is between a spouse or your civil partner, then there is no immediate tax implications at this point. If it is to a friend or a family member outside of this scope, then there is potential to be a tax implication, and the consideration paid, if it's not at market value, again, we would need to review and check this in terms to make sure the value being used for the transaction is the correct amount, and if any tax needs to be paid, the correct amount is calculated and paid across to HMRC. Another question was how best to lobby with government for sensible and workable policy. You'll be pleased to know that there are various consultations going ahead with HMRC and crypto enthusiasts and investors and people with an interest in that area, advisors, accountants, people in the legal space, to make sure that they work through they're reaching out and asking for questions and advice from the people that will be involved in reporting this to HMRC to get the best standard practice. So I couldn't comment on how far away we are from that, but they are working towards it, so everyone gets sort of peace of mind, being the main thing, that they know they're reporting items correctly and they're not missing any payments of tax that HMRC will come and query. And the final sort of question I had, I know Georgia covered the airdrops position, so that's fine. But in regards to staking and liquidity pools, which are a little bit more niche for those who are new to this space, but yeah, miscellaneous income is likely to be how staking is presented to HMRC and income tax paid on this. And liquidity pools could potentially be the same, but this is where the importance of the protocol of the exchange that you're or platform you're using at the time, to make sure you know how they treat this or how they view this. But just going back to a previous point on these exchanges, whether it's UK based or in another country, can play quite a big part on their rule set, their tax implications, and how they actually present the information to you in document form. So we have a lot of US based exchanges, as you'll probably be aware, which may report to a different deadline or a different format. So it's important to understand how they will present the information to you, how they believe it's taxed. But if we have a difference of opinion in the UK, how we need to translate that across and make sure it's reported here in the UK. So I think hopefully I've covered all those, Georgia, and there's obviously not too many questions to answer now.
Yeah, great. Thank you everyone for submitting questions. So we'll try and get through these now. The first question we've got is, can you transfer personal crypto into a company you are a director of and still charge interest on the loan into the company? So I think if I've understood this correctly, what we're dealing with here is actually two separate things. A transfer of your personal crypto into a company, you've got to be very careful. You and your company are two separate entities. So watch out for triggering a taxable disposal there if you transfer an asset that you personally own into the company, whether that's crypto or something else. Yes, you can still charge interest on your director's loan. If you've got a director's loan that's in credit and you're charging interest, that's a separate thing. You can still do that. That is between you and the company. But of course, don't forget any withholding tax and CT61 obligations on that. Hopefully that's answered that question for you. The next one is, what if the transfer of token is the same value of the new token, Why would you need to pay capital gains if you have a record showing the values are the same? Surely the capital gain would only be paid on the realized gain. So yeah, we've touched on this, and this is a really important point. I'll try and give you a really crude example to demonstrate this. Let's say, you buy token A for £1 and you swap it for token B when it's worth £100. You have acquired a token of the same value, £100, but you've triggered a capital disposal, and that capital gains is calculated as the £100 value as at that point of exchange, less your base cost, which in this case is £1, say. So you've got a £99 capital gain. Then with token B, let's say down the line you sell that and realize cash GBP, say, for £200, you've then got a gain of £100, being the £200 you've earned then, less the £100 base cost. But let's say token B falls in value and it's worth nothing and you get rid of it for nothing. You've made a loss on that token B of £100. But that doesn't change the fact you had a £99 gain on token A, even if at the time you disposed of token A, you didn't take anything out in fiat currency. So the important thing here is when we talk about a realized gain, that can be a realized gain on a crypto token, regardless of whether you've taken anything out in fiat currency or not. So that's the important point I would stress there. Hopefully that has helped clarify. The next one is, do you know how DeFi transactions are taxed? Is there any legislation published, or do we still only have HMRC guidance? I think we've touched on this a little bit, and Sean, just latterly in those Q&As, particularly when it comes to sort of lending and staking. We are in the hands of the HMRC crypto manuals. There is no specific legislation. And as Sean has alluded to, obviously it can be, it's not black and white. There is no one size fits all answer as to what the tax is, how we calculate it. So that can be where it gets a little bit more complicated. And we recommend you take your personal circumstances to an advisor. Sean, do you want to jump in on the next two, perhaps?
I can find where am I at the bottom? The last two? Is it two?
Or yeah, if I die holding crypto assets, I think you've touched on that a bit already.
Yeah, so if going back to the inheritance tax IHT point made, this is a case of obviously who is aware of what assets you own. If there's sort of a note, obviously wills are very important when it comes to inheritance tax and knowing what assets are within someone's estate, who they'll be distributed to. If in fact you want to leave certain assets to certain individuals, this is obviously the place for this to be done on a legal standpoint. And access to these, as mentioned, that different exchanges will have. You could have security keys, API keys. If you use sort of a cold or hot wallet source, it could be, I always refer to it as sort of a memory stick type thing where you can actually take it out of the online system. So you do actually own it, but upon putting it into a device, you would need the password and ID to be able to identify that it's you and it's your asset. So hopefully that covers it off. It is a bit of a sort of a planning point, but also record keeping and documentation to make sure that these passwords and IDs are accessible. A lot of exchanges will have sort of a phrase word that appears when you either log on to your account for you to store. They tend to say this needs to be written down because I think from my experience, I tried to take a photo of these and it actually comes up on your phone with a message saying not to take a photo of this in case someone accesses your device and is able to use it. So as a security point, yeah, obviously very important that only yourself and who you believe needs access to it has that access, storing that information securely. And the final question, transfer to a spouse is not taxed, but transfer to your children. Yeah, I think hopefully I answered this as part of the questions that came in. To a spouse or civil partner, obviously not taxed, but at that moment, no gain on no loss transfer. But to a relative, it could be treated as a gift, and gift in the crypto asset current guidance and legislation is a potential taxable event based on the market value of this asset. But if anything changes within that landscape, which as we know with, like I say, the upcoming government changes, we're not sure. They may revamp the manual. They may not change it at all, or they may just advance it so it's more clear, or there is some sort of regulation or legislation points we can actually follow through. But to date, that is the information we're working with. So I believe, unless Georgia has seen anything otherwise in the disclosures, that is where we're at the moment.
Yeah, that's great. That's all the questions in the chat box. If you do have any more, we do have a couple of minutes left. But obviously our contact details are up here. We can offer consultations if needed, confidential consultations. So do make a note of our contact details if you want to get in touch with any questions, whether it's Sean and private client ongoing services or historic disclosures. Or corporate related matters, we can cover that as well. We do have a big team in Menzies who can cover all aspects of crypto related activity. So do get in touch if you need to. We are here to help. Otherwise, if there's no more questions, we will wrap up shortly. But thank you all very much for attending this morning. It's been great to share some of this with you.
Yeah, thank you all.